Good day, ladies and gentlemen. My name is Michael Panamero from Pivot Financial. Thank you for taking the time out of your busy day to join me here. I wanted to send out a big thank you to Christine Hogel, Lester Hawley, and the Greater Kitchener-Waterloo Chamber of Commerce for inviting me here today. Before I tell you a little bit about me and how I got here, wanted to let you know the core mission of Pivot Financial is to help people. To help business owners make the daunting task of finding more immediate cash flow easier for their businesses across North America. One of the ways we continue to deliver on this mission is by educating business owners through public forums, live workshops, presentations, webcasts to industry organizations, trade associations, regional business centers, startup groups, and to chambers of commerce. For many of you, this presentation could be the most important presentation that you have ever watched when it comes to making a change in your business to help you thrive. When traditional bank financing is not available, there are alternative working capital solutions available to you. Over the next 20 minutes or so, I'm going to expose you to 3 of them. If you have any questions, please write your questions down. Chances are I will answer your questions with the valuable information I am about to share with you. If I don't answer your question, I will be happy to answer your questions at the end of the webcast. Now, to tell you a little bit about me and how I got here, prior to joining the alternative financing industry back in 1999, I had established and sold 3 other businesses. The most recent was a detergent manufacturing business. We manufactured concentrated dense blend laundry and dish powder detergents. Our sales were approximately $200,000 per month. We sold our products to industrial wholesalers, distributors. We did some private label for the retail chains. We supplied a coffee chain, some restaurants, and we exported as well. Until one day I got a brilliant idea to go bid on a government contract to supply all the federal penitentiaries their laundry and dish powder. In order to be competitive on the tender, I negotiated substantial early payment supplier discounts under the stipulation I would pay my suppliers in 7 days of receiving the raw materials. Well, guess what? My company was successful in winning that government contract. The government contract was worth almost half the value of my current sales, a giant feather in our cap. So with all the excitement, we went ahead and manufactured and shipped the first order, and the government paid us in 60 days. What were the payment terms to my suppliers? 7 days. Guys, how was I going to pay my suppliers in 7 days when I'm getting paid in 60 days? So I went back to the government procurement officer to ask if they could pay us a lot faster, and her answer was, we pay our invoices in 60 days. If you're unable to meet the terms of this contract, don't worry, there are other companies standing behind you that could. So what was I to do? I didn't want to lose the contract, but at this rate, I couldn't pay my suppliers in 7 days. There was no profit left in the transaction. So what does every person do when they need money? What does every business do when it needs money? We went to the bank, but we were declined because my company was growing too quickly. We really didn't want to give up the contract, so my business partner and I ended up trying to finance our business using our credit cards, and we almost lost everything. Until one day I found a solution that changed the way we did business forever, and we ended up keeping that contract. I will share that solution with you in a few minutes. From there, I realized that this financing solution could help my business. It could help a lot of other businesses, so I started brokering alternative financing solutions to my customers that were struggling with their cash flow. Soon after that, I realized that I enjoyed helping business owners solve working capital issues more than I did manufacturing detergents. So I sold my detergent business to my partner, and I became a full-time alternative business financing solutions broker. With my success in 2001, I was asked to open up the Canadian operations for an alternative business financing solutions company out of the United States. This led to me establishing a company in 2008 called the Finance Institute, a broker referral source training and support company that basically was teaching working business professionals and business professionals in transition how to broker alternative business financing solutions to their business contacts and beyond. Fast track to today, you find me as a member of Pivot Financial. So enough about me, this is about you. What I'd like to do now is quickly review some of the common financing options that are available to a business. And then what I'd like to do is expose and quickly educate you about 3 alternative working capital solutions that could change how you do business forever. So the most common working capital solutions are self-finance, commercial banking, venture capital, asset-based lending, and we will touch on the BDC because I have discovered many people don't know what they do. So let's talk about self-finance. Self-finance is usually involved in the startup of a business. It can also be used to finance a large purchase order or a contract. Self-finance involves approaching your family, relatives, friends, and asking for a loan, or like me and my detergent business, using your credit cards. A strategy I would never recommend you follow. There are some benefits to self-financing your business. The first, it's quick. No financials are required, like applying for a bank loan, because you're relying on your reputation, your relationship with your family, friends, and relatives to give you that loan. Limited paperwork is involved. Oftentimes it comes down to signing a simple promissory note between you and your relative or your friend or your family member, etc. Now, there are some disadvantages to self-financing. Many business owners are reluctant to approach their family, friends, relatives, etc. due to their pride and their reputation. And if for some reason the business owner is unable to pay back the loan in a timely fashion or pay back the loan altogether, the relationship between that individual could be ruined. Another disadvantage to self-financing is it's capped. Unless you have very wealthy friends or family, they only have so much money that they could lend you for your business. And of course, if you're using your credit cards, you have to pay the high interest charges, and once you have exhausted the credit limit, there is no more money to draw from until you pay it back. So let's talk about commercial banking. Commercial banking is a form of debt financing, which means you have to repay the funds. Bank financing involves receiving a term loan or an operating line of credit from the bank. There are many benefits to commercial banking. One is it is the most inexpensive form of financing for your business. 2, the bank provides a whole host of ancillary services like your savings account, your checkings account, insurance and investment tools. Now, there are some disadvantages to commercial banking. For starters, the bank makes their credit decisions based on the strength of the business and the business owner. Bank financing encumbers all business and personal collateral, making it difficult to pledge these assets, and many banks require that a business has been in business for a minimum of 3 years and is profitable to qualify for bank financing. There should be no bankruptcies, tax liens, or judgments against the company as well. Another disadvantage to bank financing is it's capped. If you receive an operating line of credit from the bank, there is a limit to that operating line of credit. Once you have used up all the money in that line, you now have to repay or pay that line down so you can use it again. Restricted use of funds. A business has to follow certain margins and covenants. The bank also would like to receive regular reports that shows how the money is being used. And if you don't follow those margins or covenants over time, you could end up in special loans. To implement a banking facility involves a lengthy approval process, sometimes lasting months, and also high administrative fees could be incurred. So let's talk about venture capital, or initial public offering, IPO. Venture capital is commonly referred to as equity financing, or referred to as seed capital, startup capital, and is a form of equity financing, which means you give up ownership in your business in exchange for capital. Venture capital is used in the very early stages of a business. It could be used for expansion or mergers or acquiring, buying another company. IPO stands for initial public offering, which means selling stock, company shares, to the public on the stock exchange, TSX, OTC, etc. Now, there are some benefits to venture capital and IPO. a business can raise a large sum of capital with no debt or repayment responsibilities. There are some disadvantages to venture capital. One, the business owner must give up control of the company because a venture capitalist could demand up to 50% and more equity in the company in exchange for capital. The venture capitalist may enforce certain royalties or kickers, which means the business owner would have to also pay a commission from every sale to the venture capitalist in exchange for the capital. Venture capital carries high due diligence fees, and if a business is thinking of selling company stock or shares on the stock market, there are certain Security Exchange Commission rules and regulations that must be followed through a tedious process. This brings me to asset-based lending. Asset-based lending is similar to commercial banking, except asset-based lenders' credit risk appetite is a little bigger versus commercial banking. Asset-based lending is suitable for highly leveraged companies, suitable for undercapitalized companies. Basically, asset-based lending involves loaning money against the value of unencumbered assets, which means a business must own those assets free and clear, not pledge the security to another funding facility like the bank, etc. Typically, an asset-based lender will lend up to 75% of the liquidation value of the machine and equipment, up to 50 cents on the dollar on finished goods inventory, and a certain percentage on the accounts receivable. The benefits of accounts receivable, or I should say asset-based lending, raises capital and it can provide short-term working capital. Now, there are some disadvantages to asset-based lending. One is there's no flexibility. Strict repayment responsibilities are enforced. To qualify, a business is usually required to have a minimum of $1 million of sales per month. There are some ABL firms out there that will lend to smaller companies. To qualify for asset-based lending requires strong personal and corporate financial statements. The assets, the machine and equipment, the inventory, the AR, must be unencumbered, owned free and clear. Asset-based lending limits the future borrowing power because you really can't pledge the same piece of inventory, the same piece of equipment twice to receive a loan against it. Okay, let's quickly talk about the BDC, or the Business Development Bank of Canada. BDC is a bank where the sole shareholder is the government of Canada. It is a financial institution devoted to entrepreneurs. They have a facility where a business can receive up to $100,000 in 5 business days or less if they qualify. The BDC will also provide venture capital, growth, and transition funding. The benefits to using BDC is it can help startup to established businesses raise capital. And the BDC works with other financial institutions in subordinating the assets of the company used to secure a BDC facility. This leads me to the moment that you've all been waiting for. If your company is a new startup, or if your company does not qualify for traditional bank financing, or if your company has bank financing in place, but you have exhausted the money and you're looking for more working capital to help you thrive, what I would like to do now is expose you to 3 alternative working capital solutions that could change the way you do business forever. What you will quickly discover, there are really no disadvantages to implementing or one or a combination of these solutions into your business. The first solution changed the way my detergent business did business. And in the end, this financing solution helped my business partner grow into a very nice commercial banking facility. So here's what we know. Every time a company, a vendor, ships a product or renders a service to a customer, the vendor will issue an invoice to their customer, and now what? And now the vendor will wait. The vendor will wait 30 days, 45 days, 60 days, 90 days, and even longer to get paid. Many companies will issue payment terms like 2% 10 net 30 days. What does that mean? Well, if a customer pays for the invoice in 10 days, the vendor will discount the invoice by 2%. Some vendors will offer COD discounts to motivate their customers to pay quicker. But in the end, nothing really happens. Do you know that the national average for vendors to get paid their invoices across North America is a staggering 73 days? Did you know a vendor can receive up to 95% of the total invoice amount after the invoice is created by using something called accounts receivable funding or factoring? The statistics tell us there are over 55 million small to mid-sized businesses across North America, but less than 10% of these businesses use accounts receivable funding or factoring in their business. In the UK, the United Kingdom alone, over 75% of all businesses use a factoring facility to create immediate debt-free working capital. Across Europe, over 54% of all businesses implement an accounts receivable funding or factoring facility. So why the big difference across North America? The answer? Most people, most businesses, have never heard about this concept and the many benefits. So what is factoring? What is accounts receivable funding? Well, factoring is defined as the purchase of business to business or business to government accounts receivable, which are current or outstanding invoices for goods or services that have been delivered and rendered in the past for a discount fee. Let me repeat that again. Factoring is the purchase of business to business or business to government accounts receivable, which are current or outstanding invoices for goods that have been delivered or services that have been rendered in the past for a discount fee. Factoring is not a loan. No interest is incurred, and it's similar to a cash discount. Remember the 2% 10 net 30-day payment terms that we just talked about. So how does it work? Well, there's two key disbursements associated with a factoring transaction. The first one's called an advance, and the second one is called a reserve. The advance takes place where the vendor receives up to 95% of the face value of the invoice when the invoice is purchased by a factor that we call funding source. The reserve is when the vendor receives the balance once the customer has paid for the invoice in full, less the discount fee that is charged by the factor or the funding source. Now, to illustrate how factoring works, I've prepared this little example for you. Let's say the vendor had an invoice of $10,000. And let's say the funding source, the factor, determined that they were going to advance 90%. 90% times $10,000 equals an advance of $9,000. When you subtract $9,000 away from the $10,000, you're left with $1,000 or 10% of the invoice. And the vendor will receive this $1,000 back once the customer has paid for the invoice in full, less the discount fee the factor charges. Factors are not banks. They do not lend money and they do not charge interest. A factor makes their credit decisions based on two things: the creditworthiness of the customer, length of time it takes for the customer to pay. So for the purposes of this example, let's say that the funding source, the factor, decided that they were going to charge a discount fee of just 1.5% for the first 30 days the invoice is outstanding. And let's say in the perfect world, this vendor's customer paid on the 30th day. So in this case, the funding source, the factor, would take 1.5% times $10,000 equals just $150 as a discount fee. That $150 discount fee is subtracted from the $1,000 that's still owing to the vendor, and the vendor would receive $850 after the customer has paid. So in the beginning of the transaction, the vendor would receive $9,000. At the end of the transaction, the vendor would receive $850, a total of $9,850, and the discount fee to the factor would be just $150. What is also important to note again is that standard payment terms in business, 2% 10 net 30 days. What does that mean? A customer that pays in 10 days will receive a 2% discount off the total value of the invoice. In this case, the factoring company is going to wait an additional 20 days, a total of 30 days, and only discount the invoice by 1.5% versus 2%. And the vendor in this case is going to receive a big chunk of that working capital the minute they create that invoice. Over 90%, or in this case, 90% of the value of the invoice. Okay? Now, there are many benefits associated with an accounts receivable funding factoring facility. One is you can obtain cash without creating any debt. It's quick, it's convenient, follows a very simple process. It only takes just 3 to 7 business days to set up the facility, and when the facility is set up, a vendor can usually receive their money within 24 hours of creating the invoice. The limits increase with the value of the sales. A factor does not concern itself with the financial strength or the financial wherewithal of the business or its business owners. It only concerns itself with the creditworthiness of the customers, length of time it takes for them to pay. As a new startup company or company that's new in business, you can extend credit terms to your customers to increase your sales. Why? Because now you can receive up to 95% of the total value of the invoice the minute it's created to help you make your payroll, to help you pay your salespeople, to help you meet your fixed costs, to pay your suppliers, etc. There's no long-term contracts to sign, and unlike a bank, unrestricted use of funds. A funding source or a factor does not concern itself with how the money is being used. Factoring is ideal for new startup companies to non-bankable businesses. Does not require strong financial statements, and there's no personal guarantees required. This brings me to purchase order financing. Purchase order financing is a short-term financing facility that provides 100% of the cost associated in filling a firm purchase order from a creditworthy customer for a finished good. So let me repeat that. Short-term financing facility that provides 100% of the cost associated in filling a firm purchase order from a creditworthy customer for a finished good. Ideal for wholesalers, distributors, importers, and exporters. So how does it work? Well, I've prepared this little example for you. Let's say for the purposes of this example, a distributor of bottled water received a purchase order from Walmart for $100,000. The issue, the supplier of the bottled water wants to be paid COD from the distributor. The distributor does not have $50,000, which is the cost of the water, to pay the supplier to fulfill this purchase order. So a purchase order funding source will come in and it will pay for the bottled water for the distributor. In this case, it will pay the $50,000 that the bottled water supplier requires to fulfill on the purchase order. The purchase order is fulfilled, and then the vendor, or I should say the distributor, will issue an invoice of $100,000 to Walmart. Now, if this was a factoring transaction and the factor was going to advance 90%, we would take 90% times $100,000, and the advance would be $90,000 if this was a straight factoring transaction. But because this involved a cost for the bottled water of $50,000, that $50,000 that was paid to the supplier of the water is subtracted from the $90,000 that would be advanced under a straight factoring transaction. Plus, there is a factoring, or I should say a purchase order funding fee, and this example, we called it 2%. And that 2% is multiplied by the $50,000 that the purchase order funder advanced to the supplier of the bottled water. In this case, $50,000 times 2% equals $1,000. So if you add $50,000, which is the cost of the bottled water, and $1,000 as the PO fee, or the purchase order funding fee, and you subtract $51,000 from the $90,000 advance, the real advance that the distributor would receive is $39,000. Okay? Now, if you subtract the $90,000 from the $100,000 invoice, you're still left with a 10% reserve, or $10,000 that's still owed to the distributor. And the distributor, or the vendor, or I should say the client in this case, would receive that $10,000 back once Walmart paid for the invoice in full, minus a small discount fee. This leads me to the third and final alternative financing solution that we're going to talk about in this presentation, called supplier credit financing. Supplier credit financing is a short-term financing facility that provides 100% of the cost of the raw materials to be used in manufacturing a finished good. So we're really talking about manufacturing companies. Purchase order financing deals with wholesalers, distributors, importers, exporters that need money to purchase a finished good to deliver that good to a creditworthy customer. Supplier credit financing really deals with a manufacturing company that needs to purchase raw materials to manufacture a finished good. Many times this manufacturing company has a bank line in place or some kind of loan facility, and they've exhausted all that money, and now they need additional capital to purchase the raw materials to fulfill on this purchase order to increase their sales. So how does it work? Well, in this example, we have the vendor at the top, and the vendor needs some supplier credit financing to buy the raw materials. So in this case, the funding source, the raw material, I should say, the supplier credit financing funding source, will now act as the customer, and it will now come in and it will purchase the raw materials from the various suppliers on behalf of the vendor. The vendor now decides when they're going to pay the funding source for the purchase of the raw materials. 30 days, 60 days, 90 days. How does the funding source protect themselves in failure to payment from the vendor? The funding source will carry something called credit insurance that guards the funding source against the vendor failing to pay for the raw materials. Okay? So the vendor ends up paying the funding source 30 to 60, 90 days. They'll pay the cost of the raw materials plus the raw material financing fee. This financing is ideal for companies that are presently in a banking relationship because the funding source does not require the bank to relinquish their security on the assets, because the funding source has credit insurance that's going to guard them in the event the vendor can't pay. Okay? So to quickly recap, accounts receivable funding or factoring is the purchase of business to business or business to government accounts receivable, which are current or outstanding invoices for goods that have been delivered or services that have been rendered in the past for a small discount fee. Purchase order funding deals with 100% of the cost associated in purchasing a finished good to deliver on a firm purchase order from a creditworthy customer. And supplier credit financing deals with manufacturing companies that need money to purchase raw materials to deliver, or I should say manufacture and deliver a finished good to their creditworthy customer for a firm purchase order. This concludes this presentation. If you have any questions, here's my contact information. My phone number is 416-998-3863 FUND, F-U-N-D. 416-998-3863 FUND, F-U-N-D. My email address is Mike P, as in professional, at pivotfinancial.com. Mike P, as in professional, at pivotfinancial.com. Thank you again for taking the time out of your busy day to join me here. I hope you enjoyed receiving all of this information as much as I did presenting it to you. If you have any questions on any of the information that I've covered with you here in this presentation, please feel free to reach out to me. Until I speak with you again, have a great day and bye for now.